if you think about the fund management business, again, going back to the people who are all very aggressive, who wants to win, it's naturally an industry where it's so high pressure because, again, we're making bets, making decisions every day on limited information about the future, right? It's not easy because most people don't do that. Most people are doing things based on today and getting something done. It's a deliverable, right? But our deliverable, it's a future outcome. And so that is a very intense job.
Welcome to another episode of Alpha Uncovered. My name is Alvin. I'm your host today. I'm also the CEO of OPIM. Today we have a very special guest, a good friend of mine, Mr. Anthony Jia, whose career spans over 25 years in finance, investing, entrepreneurship, and coaching. I met Anthony, I think it was 15 years ago, during one of his earlier, if not the first, hedge fund ventures in Hong Kong. The fund was called Pengu. It was a equity long short China fund, if I remember. It did eventually close, but Anthony decided to continue his career at a family office and eventually became a private investor himself, whilst he's now also supporting new hedge funds as an independent director over at Solas Partners in Singapore. Anthony recently published his memoir, Breaking the Glass Ceiling, where he talks about his career journey as well as his recent experience having successfully acquired, merged, and sold educational businesses in Singapore. Most recently, he has taken on the role of head coach, and I love this, chief storyteller at the Institute of Greatness, where he provides strategic and impactful coaching for senior professionals. Welcome, man. Good to see you.
Thank you, Alvin. Yeah, it's been a very long time. When you say 15 years, I was thinking, wow, it's been that long. It's crazy.
Do you remember what it was like? And just for the audience, so how we know each other, I was working at the group level of Oriental Patron, and we had co-seeded a fund of funds with another team run by Ronnie Wu called Penjing Asset Management. And Penjing and OP, we had incubated a fund of fund, and there was a cell under the fund of fund, which was Anthony's hedge fund called Pengu. And I remember Pengu, you were with a partner, Simon. What's his last name?
Huang.
Simon Huang. Yeah, that's right. Also fantastic. Also still good friends. I remember having the fiercest, is that the word? Fiercest conversations between the IC and the management team of all of the roughly 5 or 6 or so funds that we had incubated at the time. So Anthony, when you look back, so when you go back to those days and where you are now, I mean, it's 15 years. What was it like for you starting a hedge fund? And what do you think were the differences? What are the differences now compared to what they were back then?
I think the world is, definitely changed a lot. I think starting a hedge fund back then was not easy. It's never easy. But I think now it's much harder. Now that I sit on boards of funds, I'm a private investor. As you said, I allocate to funds. I still continue to do diligence on funds. I admire people now running funds, I think, for various reasons. Number one is the regulatory requirements are so much more stringent, operational requirements. It's so much more intensive. So like the cost of starting a fund is just much higher. I mean, the fixed cost, the hurdle to even starting that business is so much higher than before. I mean, before it was already high, but now it's even higher.
What does that number look like? Yeah, what does that number look like? I mean, in difference, right?
Yeah.
You were a two-man team. You were under a platform license at the time, or did you have your own? I can't remember.
Well, we were under a platform at a point, and then we actually had our own license as well. So we had our own office and everything. So yeah, when you come out and have your own office, your own license, that equation totally changes, right? I was telling people, I think now in terms of working capital, if you have your own, and I'm just talking about right now, Hong Kong, right? I'm not even talking about like US and everything. I mean, that's a different ballgame.
Yeah.
I think if you did not have at least ready like working capital to run the business of at least like 1.5 million, just kind of saved up, dedicate to working capital. Yeah, I think that's the minimum, right? This is assuming no management fees, right? Of course, if you get management fees, it's better. But I always tell people like, you should at least have $1.50 US saved up, ready to run this business.
And that's on top of the AUM that founders need to have in the fund, right? Because as allocators or a seeder, I'd expect you as a manager or a founder to have some of your personal assets in the fund as well.
Oh, for sure. Yeah, definitely. So yeah, this is on top of the capital that the founder will commit to the fund vehicle. So yeah, that's one thing many people don't really think about because everyone's like, oh, let's just raise capital. And then when investors' capital comes in, we get management fee that'll support the business. But then you're always beholden to that. I mean, it's important. It's a chicken and egg thing, right? Of course, like the investor will help pay your bills, but mentally, I think it's important to have your own money ready as a reserve. It's just like any business, right? When you start a business, you need to have working capital ready. That's why people go to VC route, they raise capital, but you need to have a war chest ready. So I think, yeah, that war chest now is definitely much higher than before.
Do you think it makes a difference if you're running with a partner? Because you were a two-man team at the time, you and Simon. Would that be a minimum requirement now to have a partner with you? And I guess the side question is, what are the pros and cons of having a partner versus doing it on your own?
Yeah, I think there are definitely pros and cons. So Simon and I started together as co-founders. We actually did have a junior analyst, and we also had what we call like a senior operations manager, who wasn't really a COO at the time. So really it was a 4-man team when we started.
Wow.
Yeah, it was a 4-man team. And I mean, of course, we were not hiring like people coming up from top universities or whatnot, right? With like 15 years of experience at the time. I think now it's the same. So you cannot be a 1-man band. Even two is very difficult. Not just about doing the work itself, but if you ever want to scale and build a business, no investor wants to invest in something that is like a 1-man band, right? Or like a 2-man team. It just doesn't give people comfort and trust that the money that they give you will be safe, right? I think it's the biggest things about security. But I think that's where you guys come in, right? I mean, that's the value out of OPIM. That is one reason why we also started off at a platform, is because guys like you will solve that problem for a lot of new managers, right? You will provide them with the infrastructure and actual business from day one, and then solve a lot of the other issues and allow the founders, often it's probably like a CIO or PM, to really focus on investing.
Yeah, it solves a lot of the issues, but I think the platform takes away a lot of the business risks. It takes away some of the portfolio risks. But at the heart of it, as founders, you still need to put some capital together. Platform helps a lot, but at some point you have to go independent, right? So we're only good for like we're only very, very impactful in the first 3 to 5 years. But at some point between year 3 and year 5, when you go solo, like that track record is everything, right? If you haven't made that track record in the first 3 years, it's very, very hard to continue. Would you agree? I mean, when you look back now that you're an independent director on so many funds, if you were to tell yourself or give yourself a few lessons to your 15-year-old younger self, what would you tell Anthony?
Yes, I think about that too. I get asked that question actually by my client, the ones that I coach. There are definitely a lot of things I can tell myself, right? Looking back, I think the first thing is if I were to write myself a letter, I would say something like, "Dear Anthony, fund management is a very challenging yet very glamorous industry on the surface. But then actually, if you dig deeper, the way that I get to invest professionally versus the way I invest personally and how I learn about investing through school is actually very different." And so that's one thing I wish I knew back then when I started. I think that's the first thing. I think the other thing I would tell myself in this letter is that, Anthony, you'll be competing with super smart, driven people. Everyone's there to win. And so you're just going to be a dime a dozen. And if there are a lot of things that you won't be able to control, Anthony, and so just learn to let go on things, right? Don't get bogged down and really have to move on. I think, yeah, those are the few key lessons. But I think ultimately is I will also tell myself that now, 15 years out, having gone through that journey for 6 years, is that regardless of what happens, it'll be one of the most exciting experiences of your life, and that you have absolutely nothing to lose regardless of what happens.
What I find really interesting about running a fund, it's very much a meritocracy on one hand, because all of your skill set is laid out bare in an NAV statement that's issued out and published to investors every month. It's audited, and there's no way you can fib it, no way you can erase, white it out. it's there permanently. It's like Facebook of finance, right? It's the track record is there for everybody to see. Every embarrassing short cover, every embarrassing lever up position we take or FOMO trade we do, it's there for everyone to see.
Yep.
And so at the same time, it's merciless, but it's also entrepreneurial, right? Because you're not just putting capital into the fund, but you're putting capital into the business. So on this last point, when you look at your transition, I guess previously you weren't always a fund manager and you were you were on the sell side for a bit. And when you moved over into the buy side or permanently into fund management, maybe you can tell us a few things that you wish you had been able to implement or you'd been able to adjust, maybe some advice you'd be able to give to those who are coming from the sell side into the buy side, because it's such a different environment.
Yeah. Well, I started off in the sell side right after college. I was an M&A banker in New York. And the first buy side transition, I actually moved over to private equity first. I did that for about 3 years before I switched to hedge funds. So I did have that kind of transition to buy side before going into hedge fund. I would say the biggest transition, even from say private equity to hedge fund, which was technically buy side to buy side, right?
Yeah.
Is that risk-taking mentality. It's just very different. If you're going from sell side to directly to hedge fund, it's so different. Like advising people to take risk versus putting your own capital at risk. It's very tough to really describe that feeling. A lot of people don't make that transition successfully.
Yeah.
And I'm not even talking about just sell side to buy side, even analyst to PM. And I coach a lot of now senior analysts looking to be promoted to PM. The biggest challenge is always how do you make decisions with conviction, with limited data, right? And then putting your own money at risk. That is just very, very difficult. I think the second thing is also, as you said very correctly early on, is that you're under a microscope. You're under scrutiny of everybody. You have nowhere to hide, right? And that is also very different from, say, private equity, right? Even buy side, in private equity, you have many years to really see the outcome. But here is like, there's no excuse, right? If you make money or lose money in like tomorrow or whatever, right? So that, again, that stress level is very difficult for many people to accept and to really excel in. So I think at the end of the day is that putting money where your mouth is, I think it's a very different feeling from, say, sell side, right? So I would say, yeah, those few key points. So I was very fortunate. I was already an analyst at a very large hedge fund in Asia before I started my fund. So I was very lucky to already have a flavor of that. But again, it's very different when I became a PM running a fund where I had to risk a lot of my own capital in it at such an early stage of my career. So yeah, very different feeling.
Your role at Pengu was also very much linked to the risk side as well. I remember you being very vocal about risk management and sympathetic to the IC when there's some small disputes or otherwise about how you control risk. And I think some managers are either on two extremes. They either completely ignore the risk management and they have no problems putting their money where their mouth is. They're flat gamblers, basically. They're flat out speculating gamblers to the detriment of shareholders. But then you have the other side where they are maybe, I guess to your point, a little bit too conservative with their approach and they end up bleeding out. So finding that is pretty hard.
It is. It's very hard. That's why a lot of it is really your mental capacity in dealing with this, right? Like it's about not getting carried away when you're doing well, but it's also tough, right? It's like most people, their natural instinct is I'm on a streak. Like when is it time to really bring that back or dial back the risk, right? Yeah, as you said, people are very conservative. They just don't take any risk. People are like, what's going on? I think at the end of the day that's why it is important to have a process, like an institutional process where we talk about our investment strategy is codified. What are the risk limits? And that's why there's still an overall written framework that we all have to follow. And if there are times that we exceed that, then we need to be very clear with the reason why we exceed it. And is it justified? Is it temporary? Like, what is the reason? And I deal with this too. I see clients where like, oh, their position size was, well, sometimes it's like, oh, the maximum is 10% per position. That's how it's written. And then when they start at 10% and then it does well, now it's like 15%, then we talk about it. And then they'll say, oh, the 10% was actually, it should be at cost, not the total.
Yeah.
Right. So like, yeah, it's things like this, right? But of course you can kind of tell it's because now it's like getting carried away or it's like it's making money. So people think about like, oh, let me try to adjust the risk limit to my favor as the manager. Right. So it's always like people want to do things to their favor. I think at the end of the day it's also communication between the manager and the investors. It's about really explaining to them, letting them understand what the thought process of the manager is. And then, yeah, you just need to have a framework that ultimately is what's sustainable and replicable over time because market conditions will change.
I totally agree. Articulating in disclosure is one thing. Moving the goalpost or having the flexibility to move that goalpost once in a while, I think there's some tolerance investors are okay with. Your example earlier is quite interesting and quite telling because you mentioned, let's say the cap is 10% in individual stock. If that position naturally, because of market factors, becomes larger because the rest of the book kind of remains the same, the one position grows, and so it exceeds 10%. In a mutual fund, like a UCITS fund, like a European mutual fund, you'd be forced to rebalance that relatively quickly within a certain amount of time. There's usually a guideline that says, okay, this would be rebalanced within 14 or 15 working days or maybe a quarter or something like that. But the one thing that I usually remind investors, even in private funds, not in mutual funds, is that even if that one position grows, and I understand that you want the winners to ride and you want to let it ride for as long as the market will pump it, so to speak. But you have to remember that you have investors who are investing at different stages of the investment cycle. Not every investor came in on day one of that play, right?
Yep.
When you came in at cost. You have investors who are coming in after you pumped 10%. And so your responsibility to investors is to ensure that they have a consistent experience,
Yep.
regardless of what point of the investment cycle they're coming in at.
Yes, that's very correct. Yeah, I totally agree with that. So that is a tough balance, right? Like investors want you to ride the winners, but yeah, investors who come in at different times. So it's like, I don't want to be buying this stuff at like the peak, right? But well, what is the peak? You don't know. So yeah, I think it's a very tough balancing act. So I think it comes down to really communication. And I think that at the end of the day is if what you promised in the framework is whatever risk, you just have to stick to it, right? At the end of the day, if you're forced to sell, you sell. Or, I mean, sometimes you can explain to investors and be like, look, I still want exposure to this because it's doing great. If investors buy in, switch to derivatives. I know on a notional exposure is probably still the same, but at least like you're protecting the downside, right? If there's a big drawdown, at least you've capped your downside, but you can still ride the upside. So I think investors will kind of understand that, right? We switch to a call option or something, right? So yeah, it's the communication. That's something I also learned and it's something I wish I'd done better with my investors back in the days.
Yeah. Going back to building a team, like when you think about lessons learned about your relationship with your partners and relationship with your LPs, are there any learning lessons there or maybe different back in the day than it maybe it is now? Or perhaps things that you think every manager should remember when they're dealing with like seeders, for example? How do I work with the seeder? How responsible am I to a seeder?
Yep. One thing that I think when people are starting out, especially their first business, and I'm sharing my experience having personally founded 2 businesses, and now as an investor in VC funds and co-investments, I also help a lot of other entrepreneurs. I think the legal document from the very beginning and alignment of interest is key, regardless if it's a seeder or other LPs, right? Sometimes I feel that people are very excited to just get started and be like, oh, I got money, I'm just going to get started. And a lot of things that will be sensitive, you kind of just don't talk about it up front, thinking everything will be great.
Like what? Like what's sensitive? I kind of know what you're talking because everyone's like, oh, let's get it done. And everyone's accommodating to each other.
Yeah.
Is that what you mean? People are too accommodating in the beginning, but then when there's a dispute?
Yeah, I can share with you a little bit of my lesson with Pangu ties into corporate governance, and now it also frames how I think about corporate governance as an independent director, right? I mean, again, it's a very valuable lesson. So Pangu was operating for 6 years, and then as you said, we ended up winding it down. The biggest reason we wound it down was because of corporate governance, actually. What happened was, so I started out with me and my partner, Simon. And then around like year 3, 4 of the business, we actually brought in 2 external investors who happened to be, they were business partners themselves. So they invested in the investment manager, right? The Hong Kong SFC licensed entity. So they brought in capital. We were able to really enhance the infrastructure and take the business to the next stage. We're all very excited. And then next stage, the plan was for the investors to also inject more capital as we continue to grow. What happened was these two investors were supposed to be really close business partners. They themselves had a shareholder dispute amongst themselves. We don't know what happened. They just kind of disagreed on certain things behind the scenes, maybe with their other businesses. So one of the investors, the larger one, actually wanted to inject more money into Pangu. The other one didn't. And then when we look back at the shareholders agreement, there was actually a clause that says for any capital injection, it had to be unanimous. If not, basically the smaller shareholder that we brought in, basically he was smart enough to put in like an anti-dilution protection in a sense that if there was any capital injection, if one of them didn't want to inject, the other one basically had to give him free shares so he would not be diluted. Right?
Wow.
And so the larger shareholder was thinking like, he really wanted to give us money, but he's just like, well, I can't give you money and then give this guy free shares. So he never gets diluted. But structurally, there was already something wrong with that shareholders agreement because we cannot run a business where some guy basically is just going to get a free ride and never get diluted, right? So these were things that we kind of knew at the beginning when they brought in the capital, but everything was, oh, come on, we're all buddies. We're going to make this like a really big business, blah, blah, blah. We're like, okay, let's just do this. Let's just do this, right? And so I was CEO at the time. I was watching these two guys in the background. And of course, our business was like, well, is the capital coming in, not coming in? And we're basically stuck for like 6 months, kind of like in limbo. And that's the reason why we ended up winding it down, because I was just like, well, we're not going to go anywhere with these two guys kind of hanging out in the background. But fortunately, what happened was then the fund vehicle, the Cayman Fund, appointed another investment manager. I mean, that's basically you guys at the time, right? So my partner, Simon, ended up going to the new investment manager to continue to run the Cayman Fund. So the Cayman Fund was intact. I actually stayed behind for a little bit to wind down the vehicle, the Pangu Capital license in Hong Kong. So I was the one who petitioned to wind down the business. So if anybody wants to learn about voluntary liquidation, do let me know. I've gone through this, not easy. But instead of going to the new investment manager to continue managing the Cayman Fund, I then left and went to a multi-manager platform to be a PM. But my point is, this is an experience where, again, goes back to alignment of interest, having proper legal documents. It's extremely important. Again, a lot of PMs spitting out of big shops or people who are thinking about investing, these are things that we know is important, but we don't really think about it or really don't attribute the seriousness of these matters, right? Until it blows up. And you'd be amazed, like so many businesses across industries fail because of corporate governance issues or misalignment of interest.
Do you find it ironic that, and I don't mean this, I'm not pointing to this observation of your team, or Pangu. I'm just generally across, now that you're an independent director on so many other funds, do you find it interesting? I find it a bit ironic because a lot of these teams, the founders come from an analyst background or from a previous background where they have scrutinized other companies for their corporate governance to a very, very high degree. But the moment that they want to build their own firm, they're making often very similar, if not identical, mistakes that they scrutinize other listed companies for.
Yeah, I would say that. Yeah, if people are like, oh, look at this management team, like, oh, everything's owned by one shareholder, or like this guy could be like untrustworthy and like we would never invest in such a business or whatever it is, right? And then like, yeah, that's why it's tough. People just feel like I'm different, I'm just better, or a lot of it, again, it's because we are very super competitive people. We just feel like, I don't know, it could be an ego thing. And I do tell my clients when I coach them now as a executive coach is really put away that ego that's inside of all of us. And the fact that we always think like, this won't happen to me kind of mindset. Like, really, how would you analyze that situation objectively, right?
So on this, tell me more about your coaching, because on one hand, I want to ask you about this chief storyteller at the Institute of Hedge. I want to know what's included on the job description for that. But going back to your coaching, which I think is linked, I think of the lady in Billions. Oh, I forgot.
Wendy Rhodes.
That's right. Wendy Rhodes.
I'm becoming a Wendy Rhodes. That's what people call me now. You're like a Wendy Rhodes.
Is that what you do? It's kind of like a part-time performance coach on the analyst or the PM side, and then it's also mental health or more psychological assistance in the way that we watch on TV.
It is in many ways exactly like that. So, well, as a coach, so I actually coach many people across industries. It's not just finance. So some of my clients, I mean, they actually wrote me testimonials on LinkedIn so people can see it. But like they come from, it could be government agencies, it could be tech, it could be services companies, whatever it is, right? But when it comes specifically to funds, yeah, it is like in many ways, like a Wendy Rhodes. It's a lot of it is, if you think about the fund management business, again, going back to the people who are all very aggressive, who wants to win, it's naturally an industry where it's so high pressure because, again, we're making bets, making decisions every day on limited information about the future, right? It's not easy because most people don't do that. Most people are doing things based on today and getting something done that's a deliverable, right? But our deliverable, it's a future outcome. And so that is a very intense job. And now in this industry, in finance, it's all about people, right? It's all about talent management. It's the one who has the most talent and the best talent wins. But what is really the best talent? Best talent is the one that can also sustain their peak performance. So if you think about sports, I mean, we talk about sports and tennis, right? It's like, why is this guy just so dominant? Right? At the end of the day, it's not about the fact that, oh, he knows how to hit a forehand better than the other person. I mean, at the end of the day, it's like the technique, it's basically the same. But who is able to sustain that mental peak state longer than somebody else? That's number one. Number two is who is able to really thrive and perform in times of adversity, right? And ultimately these are the two key things that will allow a manager to say, hey, I'm going to outperform you by 50 bips, which is a lot. Right? If you think about a fund running billions of dollars and be like, hey, through coaching, this guy can deliver 25 bips, 50 bips more performance, that is a lot of money. And that could also really help a business really differentiate itself. So, I mean, that's what Wendy Rhodes did in billions. And yeah, that's what I do for some of the funds. So I'm not like an in-house full-time coach, but for funds that are smaller, that don't have the budget to hire like a full-time in-house, like a Wendy, then they would outsource it. And so, yeah, I coach people from like COOs to analysts, to PMs, to CIOs.
Just quickly on that point, you reminded me of a speech that Federer gave at one of the university graduate class. I can't remember which school. Dartmouth, right? And he goes, in the 1,526 single matches he played in his career, he won almost 80% of those matches. However, he only won 54% of the points in those matches. So the 80% wins came from only 4% edge.
It's funny you bring that up because I use a similar anecdote with my clients for them to really relate to what really differentiates between a winner and a loser. It's those clutch moments, right? So it's funny. Yeah, it's great you bring that up because that's one example I use. I think that's a really, really useful one.
So when they come to you and you work with the employers, I'm curious. So I guess the first question is there a performance metric for the work that you do where the one hiring you is like, okay, after, I don't know, 3 months, 6 months, if they see a marginal increase in their performance, is that accretive to your credit?
It's tough to attribute a specific number. It's like, oh, if I didn't have a coach, I would be at A. Because I had a coach, it's like A plus 30 bips type of thing. A lot of it is really subjective and anecdotal. So we do get feedback. I do ask clients for feedback and they will share with their employer that, like, how do you feel now? And I always ask them, like, one way to measure whether or not I'm doing my job is I will ask my clients, like, okay, so right now at this moment, as we're starting our coaching session, like from a scale of 1 to 10, 10 being like, oh my God, I feel excited, I'm so energetic, to like 1, like super low energy, etc. Like, where are you now? They'll be like, like depending on what the criteria is, they'll be, I feel like I'm in a 5 now. I say, oh, no, where do you want to get to in X period of time? They'll be, I want to get to a 7 or something, right? So that's how we kind of lay out the foundation. And then as we go along, I'll ask them, like, how do you feel now? They'll be, I'm moving towards a 6. I'm moving towards a 7, right? And then, like, I'm able to achieve my original goal of getting to a 7 within 3 months or 6 months, whatever that is, right? So that, to me, is considered a win? And I ask my client the same thing. I'll ask them like, what in your mind is considered a win for you, right? I'm not talking about going from making like 3% to 15% in performance, but really like mentally or different aspects of your career. This is the rubric, the metric, the score. Where would you want to get to realistically, right? So that's one way to kind of measure whether I'm doing my job, whether they're happy with it. On this point, also back to this whole chief storytelling thing. So why do I call myself a chief storyteller, right? It's because, at least to me, I have kind of grown up over the years using storytelling to really help myself visualize an outcome and also really get through some of the toughest times. Because at the end of the day is we are the ones who is the author of our own story. Like our life is just a story, right? It's just like a movie. So either I can choose to be the main character of my own inspiring story, or I could be the supporting cast of somebody else's story, right? So that is a choice anybody can make. I also have a choice to write the next chapter of my life. I can write a plot about it, right? It's my own imagination. Again, that is within my control, right? And so for me, it's every time I have adversity, same thing. Like when I started Pengu, this was 2009. I was laid off from my previous fund because we shuttered in April of 2009, right? Because of financial crisis. And like starting a fund at 30 years old was like the last thing you can ever think about, right? After being laid off, it's such a difficult time period. But I was telling myself, I said, because it's so difficult, the more difficult it is, I can imagine this story being like, oh, this really great climax. It'll be so dramatic, but it'll be so exciting that when I look back and read about this chapter of my life, it'll just be like so inspiring. Like, so at that point in time, that was the story I was telling myself.
Oh, dude, you were at one point, Pengu was the #1 new hedge fund, long short China equity hedge fund. You were front page of the HFM magazine.
Yeah, we were
for the league tables.
Yeah, we were nominated for Best New Asian. One of the, I think it was, I don't know, maybe like 8 nominations or something. One of the nominations for Best New Asian Hedge Fund of the Year. And I always laugh about that, right? So as you said, like, what's a win, right? What's a defeat? To me, it's, you know what, that's a win, because I just feel like that's what I accomplished and nobody can ever take that away from me, right? But my point about the whole chief storytelling thing is that's what I do with my clients. It's like, oh, they're going through a bad streak. It's like the end of the world. Everything is just wrong. And I'm just like, okay, well, let's just really visualize, come up with a story, right? Let's just say we fast forward a year from now in 2026. You and I are talking. Now let's talk about this story that happened in the last 12 months. Right. So it's very useful, I think. That's what I'm trained to do. Like I'm a trained coach and I help clients, especially those, usually people who go through coaching is either they really believe in self-improvement, which is great. Often is they're going through tough times. So how do I extract them mentally from that tough time? Right. It's storytelling.
It's interesting. It's actually a misnomer, because when I see the title Chief Storyteller, I'm thinking, oh, he's going to help his clients through a series of anecdotes and stories that he's learned. But it actually sounds quite the opposite. It's more forward-looking, is how do we help you as the client, as the subject of your own story, write out the next chapter of your life, which is, I think, was really quite interesting.
Yeah, I call myself, I am your author. So I'm just like a ghostwriter of your story, and I will help you and assist you in narrating your own story. But whatever story you narrate, it'll be an incredible story. I'm just going to help you write it down. So that's why I call myself like that chief storyteller. And the testament to that is I wrote my own book. So that's why it's called Breaking the Glass Ceiling, Insider Memoir.
I was about to ask. Let's talk about your book. Okay, so Breaking the Glass Ceiling. Again, I haven't read the book yet. It's on my to-read list. Just looking at the praises and the summary and looking at, but first when I looked at the title, I thought, oh, Breaking the Glass Ceiling. And I was thinking about as a career, what it's like to break the glass ceiling, mostly on a corporate level. But it feels like you're talking about the glass ceiling at an entrepreneurial level. So why don't you walk us through what you meant by that?
Sure. So what I meant by that is breaking the glass ceiling is we, in many ways, were trained to live a life. In many ways, it's conventional, right? Like many people are like, oh, we got to study hard. We got to get a good education, go to good school, come and get a good job, get promoted, blah, 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 right? That's a majority of us. And for me is my path has been somewhat unconventional, according to what many people say. But for me, I think it's conventional. So when I say breaking the glass ceiling is what can we do to get out of our comfort zone to do something that is deemed unconventional or different. That's all it is, right? And so I wrote this book to share a lot of my, I would say, ups and downs, a lot of I wish I could have done things differently, or my failures. I'm a very open book about it. I talk about like I was born with a birth defect and everything, right? And so at the end of the day—
You were born with a birth defect? What was this defect about?
Yeah, so at the age of 5, I found out that I actually had a heart problem. So I actually had to go through open heart surgery at 6 years old. So I was hospitalized for basically 6 months. I had to be taken out of school, open heart surgery. So like I have a big scar on my chest, right? And so I couldn't play sport. And doctors, oh, you need to be careful. And telling my parents, oh, you got to be careful. It's going to be like a long road to recovery. But yeah, that never held me back. Like my parents never treated me differently. They never thought of putting me in like a glass jar and like take care of this kid type of thing, right? So I lived a normal life and I kind of went for what I wanted to do. And physically, like I love sports. I'm very active. I consider myself pretty athletic, etc. Right? So like that never really changed my life in terms of holding me back. But my point is like talking about these stories is that, yeah, everyone's different. It's what you choose to do with your life going forward, right? And so, yeah, my book was really written just to, I wouldn't say inspire people, but just to let people know that any ordinary person can do different things if they choose to. And to be honest, a lot of this actually was inspired by people who reached out to me over the years. They actually would just contact me on LinkedIn after they saw that I left fund management full-time. And then I started my own preschool business in Singapore. So I switched to education. And a lot of people are like, oh, how did you have the courage to leave finance and move into an industry you've never been in before? You had no prior experience in blah, blah, blah. So like people would just ask me these things. And I used to talk to them for free.
Questions. Yeah, all very good questions. You went from running a hedge fund, running a firm to now, I guess, double hatting on one hand, being as a coach, also an independent director, but now also as a successful entrepreneur. I understand you accumulated a collection of small businesses, small educational businesses in Singapore, and you recently sold and made bank. So congratulations on that.
Thank you for that.
That's great.
Yeah, I'm happy with that exit. Thanks for that.
So tell us a little bit about the deal and what you took away from it.
Yeah, another interesting chapter of my life, which is also written in the book. Again, going back is now, if I hadn't gone through my experience in Pangu, which was very, very valuable. I learned so much. Whether or not it's a success or not success, people can decide. For me, I still think it was a success because that chapter of my life was a building block to the education business. So whatever lessons I learned, I applied it to the next chapter of my life. And then just to rewind a little bit, kind of why I got into the education business, I moved to Singapore about 8 years ago to join a family office. In the period I had my first kid, I just somehow felt I wanted to educate my kid according to my own philosophy. I couldn't find any schools that I liked after visiting many different schools. And I just kept telling myself that I can do it better than these people, like all the schools that I visited. So at first I felt like, oh, well, one way to do it was I would buy a business, like what I was doing in private equity. And that's what I did. I bought one school. And then after a few months, I ended up leaving a family office job to dedicate full time to the preschool business because I was still deciding, like, is this going to be a side hustle? Or is it going to be like a real business? And I knew if I didn't leave and commit to it full time, I would not turn this into a real business. So then I left the family office in early 2019, after 2 years or so in this family office, which honestly was actually a very good job, very comfortable, decent pace. So I left the family office early 2019 to dedicate full time to the preschool. What I did was then I spent the next 5 years acquiring preschools in Singapore. I went from 1 location to 5 locations, mostly through acquisitions. I did build 1 location from scratch. It was a greenfield. Our staff count went from 8 to 50 females, 100% female. I was the only male staff in the company. Yeah, we grew revenue by tenfold. And then last year, the business was acquired by another strategic player. So I fully exited that. So it's a very typical private equity role of play. And I'm very happy with the outcome after 5 years, because that was, again, telling myself the story. That was kind of what I visualized, that this would be the outcome when I was writing this chapter of my life.
I guess it's a serial condition, they say. Do you see yourself doing more of these roll-ups now that you've had a taste of it? Because entrepreneurship is a serial condition. And this is not your first, I guess. This is like your third venture out, if not fourth.
I would say officially my second. Hedge fund was the first one. This education is the second one. Coaching, you can call it a third one. Still early stages. I definitely am more of an entrepreneur than like a typical employee. But having said that, I don't see myself really being an operator again. Like I could be entrepreneurial, but I don't have to be an operator. Like I was an operator for the hedge fund, an operator for a preschool, right? What I see myself being entrepreneurial is being more advisors now. So like I advise, or a couple PE firms approaching me to advise them on deals, how to do post-merger integration, how to look at certain businesses. So from that perspective, I'm still being entrepreneurial, but more strategic, but not as an operator, which is not easy. Like having been that investor as a hedge fund, private equity, and then being a businessman and being operator on a daily basis, it's very different. I've seen all spectrums of that. So I admire operators. I really admire people who can do that.
So maybe one last question as we kind of wrap things up. It's actually more related to about the entrepreneurship. One of the hardest parts about being an entrepreneur is raising capital. So when you look at these smaller deals that you've done, you worked with a family office. What advice can you give to early stage entrepreneurs who want to do something like this and they don't have that much money on the table? What advice can you give them about raising capital and sources of financing?
Are you talking about starting business in any industry, or particular to say fund management?
No, in these smaller businesses, more related to what you did with education.
Okay. Well, it's funny you bring this up. I actually just did an interview, which will be published hopefully soon on my LinkedIn, about how to buy a business step by step for any normal person out there. I would say if anybody wants to have a different experience or start a new career, buying a business is the easiest than building from scratch. That's number one. Second thing is then how do you actually get into it? And a lot of it is the financing. There are many ways. So one thing that's very common now, I mean, aside from the typical debt to equity, right? Equities, if you have the money, sure, right? Debt you borrow, but it's actually very difficult to borrow because these are not very big businesses. So you can't really go to a bank. Or if you do, then it's just very difficult. It's going to take a long time, but right now it's difficult to, interest rates are very high, right? So let's say the traditional bank financing route also not available. Then one of it could be what we call like seller financing, which is let's say if something's $100, you can convince the seller in ways where like, okay, I'll give you $30 up front. Then the remaining 70, I'll pay you over time with the profits of the business, like a typical leveraged buyout, right? But of course, why would a seller agree to that? Is you got to give them some upside. So instead of me getting 100 as a seller today, by doing seller financing, I could get 130 in the future, right? So many ways to negotiate and structure the deal. So that's what I did too with some of my deals, using other people's money to buy their own business, right? Using the seller's money to really buy his or her own business. So there are creative ways to do that. Or it could be like, oh, I'll give you upside. Like, oh, if the business exceeds whatever, I'll give you more return, whatever it is, right? Future economics. So yeah, different ways of crafting a deal. I would say that's definitely not easy for any entrepreneur to start. But again, having done it now, I look back, I say it's one of the most rewarding experiences you will have in life. And you'll always turn out a winner. Like financially, even if you don't turn out to be a winner, overall as a person, you will grow so much and you will just have a different perspective of life and realize, oh, you know what, life actually can offer many different things than just like what we're used to. Yeah, and I think maybe just adding a little bit on fund management, for example, right? Like one thing that I learned, and again, relates to your question earlier about if I could give myself advice to the 30-year-old Anthony who started Pengu at the time, is that now that I've built businesses and really back other entrepreneurs, one thing that I wish I knew, and I think honestly today, many fund managers, when they start out as a new manager, that they find difficult to transition, is the idea of taking the mindset of a portfolio manager investor versus a business person. These two mindsets are very different, and it's not easy to make that transition. What I mean by that is, so for me, when I started, like most fund managers, we were all trained to make money. That was our job, right? So we all think like fund performance is the panacea to everything. As long as we have good returns, we can build a business, right? But if you think about it, we're not building just a fund vehicle to make money. We're trying to build an asset management business where the fund is just one of the products or services that we're offering to clients, right? It's like a restaurant. It's like literally the fund is just one of the items on an a la carte menu, right? But we always think like everything is about the fund vehicle. It's a way to make money versus I need to first build a business that people can trust and really feel like I'm comfortable with the business before they can part with their money. And I, like most fund managers, when we start out, we don't really think about that. And so that's one thing now I coach a lot of the new managers on. It's like really think about it's a business in a sense that how will you make your clients comfortable by giving you money? And it cannot be performance. You cannot tell me just because I have good performance, they will feel comfortable giving me capital.
I see two takeaways from this, actually. One is it's only one of the products and services, but it is a product and service. And so you're accountable to investors, not just on the day they put money in, but for the lifetime in which the money is in. And then to your earlier point about you're actually building an investment management business, we also have stakeholders at the investment management level. Unless, of course, you're fully self-funding the investment management vehicle, which is very rare these days. Most managers have a partner. Even if it's a managing partner, they're accountable to each other. And if it's a seeder, they're accountable to the seeder. So generating not just a rate of return on the fund, but also a rate of return on the business, you're actually accountable on two major fronts there.
Yeah, it's a lot. So it's really about now thinking about how to deal with people rather than just like a ticker in a Bloomberg screen. And that is not easy because most PMs were not trained to do that, right? And
to deal with people.
Yeah, deal with people, right? Again, that's why it's important to have a good kind of COO or you need somebody who's really a strategic people person, not just an operations person, right? But again, that's why you guys come in, right? You guys can really solve a lot of that at the beginning for somebody to get to critical mass. So that's something I wish I told myself, right, back in the days. I'm building a real investment management business and not just the fund vehicle that makes money, which is actually quite different.
So what's next, Anth? What's next on your to-do list? You're coming into power. You're in the hottest city in Asia and Singapore, also going back to Hong Kong as well as you hear. So what's on your docket?
I think this year, well, for me personally, whatever I've been doing, continue to just build on that. So continue to serve my clients as an independent director, something I really enjoy. I've been doing that for now 5.5 years. Continue to build up my coaching business. I'm looking to be a public speaker as well. So like part of it could be like corporate training, like group corporate training, speaking in events. Again, it's something that I just transformed into over time that somehow realized I actually enjoy doing that, which is surprising because I used to really enjoy sitting behind Bloomberg screens and drawing technical analysis charts. And now it's like, I like to go out and speak publicly. I think those are the few key things. And yeah, that's my big plan for this year. Yeah, thank you. I appreciate that. I'll definitely keep you posted. And I really appreciate the time today. And yeah, our many years of partnership and friendship. I've learned a lot from you as well over the years.
Yeah, likewise, man. It's been good. Let's kill it. 2025 is ours for the taking. Both of us sit on a lot of fun boards together, in fact. And I'm looking forward to seeing you on the circuit. Thanks for joining us.
Thank you.
Talk to you soon.
Appreciate it.